But we begin, as always, with three things investors ought to be thinking about right now. Big tech stocks led the week's market rally. Now investors are turning their focus to the Fed's Wednesday rate hike decision. The bank turmoil isn't over. Depositors continue to yank their cash out of First Republic. Is the contagion contained? And introducing Kenvue, what to expect from the biggest IPO of the year as Johnson & Johnson spins off its consumer health business. On the Barron's Roundtable, my colleagues Ben Levisohn, Carleton English, and Andrew Berry. So, Ben, the S&P continues to inch higher. On the surface, at least, not that much is happening. It's kind of boring.
Yeah, I mean, you could say that the stock market had a Microsoft landing this week. Pardon the pun. Thank you. Microsoft had great earnings. The stock gained 7%. Alphabet went up 1.7% after its earnings. Meta jumped 13% after its earnings. And these big stocks are really doing the heavy lifting for the stock market. And that's why all three of the major indexes, the S&P, the Dow, and the NASDAQ, finished higher this week.
Yeah, Meta is getting out of the metaverse, and investors cheered that.
And it's going to have to go back and change its name to Facebook.
So here's the thing. These big tech generals are leading the march higher, but you look at small caps, they're not doing very well. What's going to happen here? Do you think the generals can drag everybody else along with them, or are they going to move aside and we'll have a lousy market?
I think they're going to move aside and we'll have a lousy market. They have been driven by lower yields and by just really bad sentiment towards these big tech stocks last year. But we've seen both of those are basically ready to reverse. The sentiment on these stocks is fantastic now. Everyone's buying them because they look around and said, oh, these are the things that worked before. They had a bad year. We're going to buy them again. And they've done great, but they've gained a ton. And then you look at the yields, and they've basically come down, I think, as far as they're going to for a while. And then you look at everything else, and they're acting as if a recession is coming. And so you need something to pick up the baton. I'm just not sure what it's going to be.
All righty. So next week, we've got the Fed meeting expected to hike 25 basis points, a quarter point. And then also we'll have jobs report for April. What will you be watching?
Well, I think that we're going to be listening to what the Fed says, not really at what it does. The market expects that a quarter point hike. I think that's what's going to happen. But then the market expects a stop. I think the Fed might portray it as a pause, but the stock market's predicting an actual cuts later this year. So I think that's really what they're going to be listening to. The job report is going to be important, but it's going to come after the Fed meeting, so I'm not sure it's going to have that much of an impact following that Wednesday meeting.
Gotcha. All right, so one thing I don't think we have to worry about, Carleton, is a banking contagion. First Republic has been awfully ugly, but it seems to be ring-fenced.
Yeah, so when you look at the news, we saw most of the banks report earnings. Most were, we had a lot of beats, but most were in line. Even the banks that may have missed, it was within a reasonable margin. What shocked the market with First Republic was the extent of the deposit flight. There was about $100 billion that left. You had to have 30 billion influx from JP Morgan and 10 other banks. So with that bank, it really is a unique situation. It's a bank that catered to a kind of wealthy clientele. It was known for offering kind of like sweetheart deals for mortgages and other lending. That's not a traditional banking model and not one that works in a rapidly rising rate environment.
Mortgages on very nice houses.
Yeah, I think if you look at the mortgages, they're concentrated in the New York area in places like East Hampton, Greenwich, Connecticut, and Tribeca.
That, and you're only paying 1% on some of them. Their average loan portfolio had a yield of 3.2%, which not very enticing for anyone that was looking at the banks.
Yeah.
So if this is the end of the problem, does this mean that customers at these regional banks can rest safe at night feeling that their money's secure?
Yeah, so customers at the banks, yes. FDIC insurance steps in at $250,000, per account registration. That applies to most people. And then also you have to think of First Republic. They had so many clients that had balances well in excess of that. When you look at the uninsured deposit levels at most regionals, it's not to the same extent that it was at First Republic. The stocks might be challenging, but your money, your savings is safe.
Gotcha. So, Andrew, I want to ask you about the IPO market, which really kind of dried up when the market went south last year. But there's a big IPO coming to market. Johnson & Johnson spinning off its health business. Yeah,
it's going to be the biggest IPO of the year. It's called Kenvue. It's their consumer health business. It includes some of their well-known brands like Tylenol, Band-Aid, Listerine, Johnson's baby products, and it should go pretty well.
All those famous brand names. I don't know how they ended up with Kenvue. But anyway, it's interesting because one of the best times to buy IPOs is when nobody wants IPOs, right? I mean, if you can actually come to market in this kind of an environment, it suggests it's a pretty healthy company.
Yeah, it's a pretty good deal. It's pretty reasonably valued at around 16 times last year's earnings. There could be a 3.5% plus dividend yield, durable brands, and reasonable growth prospects.
Okay, one interesting question. You've got two companies now, or you will soon, instead of one. You want to guess which one will grow faster, or you think they're similar in that way?
I think J&J grows a little bit faster with its pharmaceutical and medical device business, but I think from a stock market perspective that Kenvue could hold its own.
All right, because you felt that this whole spinoff was maybe not that necessary, is that right?
I'm not quite sure why they even needed to do it. For years, J&J said the company was better altogether, and now in the last year or so they say, well, it's better splitting it off, and they may be jumping on the whole spinoff trend in the industry. I'm not quite sure how much benefit there is to J&J shareholders, but you'll have a nice company emerging from J&J later this week.
That's just a Band-Aid.